Hey, I'm Salina Amaro, owner of Cedar Rose Consulting, and today we're going to talk about accrual versus cash accounting methods. When we talk about accrual, your income and expenses under the accrual method are recognized when they are either earned or incurred, regardless of what the cash transaction shows. Something to also consider when it comes to the accrual method is for 2024 at least, if over the past 3 years you have averaged more than $30 million in gross receipts or your inventory is in excess of $1 million, you're actually required to be on an accrual method. This means that your invoices and your expenses line up in the same period. So for instance, if you have a client that you did work for in the month of January and you invoice them on February 1st for those services, just right off of the bat with simple accounting, your income showing up in the month of February, but the expenses related to that work is actually in the month of January. So you would want to accrue those January expenses to the month of February to ensure that your income and your expenses line up. This is a really good way to get a very clear picture of what your overall profitability is for your business on any given period of time. Additionally, outside of accrual, you then have your cash method of accounting. Cash method of accounting is actually very simple in terms of your revenue and expenses are actually recorded when the cash is actually received or when it's paid. This means that when the money comes into your bank account, that's when you report it as income. And when the money comes out to pay for your expenses, that's when you report the expenses. The downside to this is there's usually a pretty long period between when the expenses incur and when the income is actually received. So in that same scenario, you did work for your client in the month of January, you invoiced them on February 1st. That income from that February 1st invoice might not be received until the month of March, maybe the month of April, depending on how quickly your clients pay you. And so then the downside to that is you have potentially a 3 to 4 month gap between when you paid for all those expenses related to that client to when you were actually paid on it. A very clear way to understand your financials, but also loop in or wrap in the cash part of it is to do your accounting on an accrual basis and then really utilize the cash flow statement to see how the profitability from those accrual financials convert to your overall cash and bank account. So on an accrual method, you're going to have a profit and loss statement that shows your income and expenses whenever they occurred. And let's just say for the month of January, that's a $20,000 profit. Then you look at your cash flow statement and we break down where that $20,000 went, where other money went that didn't necessarily hit your profit and loss, whether it be credit card payments or loan payments or shareholder distributions. All of that is encompassed on your cash flow statement, and it gives you at the end of the period what your beginning bank balance was, what your ending bank balance was, and what the overall change in the cash was. If you feel like you're doing the wrong accounting method at this point, or you'd like to just switch to accrual to get a better understanding of your books, we at Cedar Rose keep your books clean and ensure that you understand your numbers so you can focus on growing your business.